Well, good morning, everyone, and welcome to the Experian Quarterly Business Credit Review for Q3 2018. I'm Gary Stockton. Before I introduce our speakers, I'd like to remind you to take the opportunity to engage our experts using the Q&A box here in the WebEx applet. We're going to try to answer as many questions that you have at the end of the program. We're going to let our presenters present the material. If you are having any audio problems, just recommend try dialing in. Sometimes if you dial in again, if you're not able to hear the presentation, although if you can't hear, you're probably not hearing me give these instructions. But WebEx webex.help.com would probably be the best course. Otherwise, we're going to have a recording up on our website here probably in about another 24 hours. You can watch back then. We've put a copy of the slides on Bitly. We've got a Bitly link here. Just enter it exactly like this, bit.ly/Q318QBCR. That link for the slides is in the lower right corner of just about every slide on the deck, so you should be able to get a copy of the PDF of the presentation to share with your colleagues at any time. We'll also send a note after the presentation along with a link to the recording. During today's webinar, we're going to be discussing key findings in the just released Experian Moody's Analytics Main Street Report for Q3 2018. Our speakers today will be Gavin Harding of Experian, Derek G. McCrank, and Christian Derides from Moody's Analytics. Gavin is a senior business consultant with Experian Advisory Services with more than 20 years in banking and finance experience. Gavin leverages its expertise to develop sophisticated data and analytical solutions to solve challenges and develop strategies across the customer lifecycle for global banking and fintech clients. Derek Grunfelder McCrank is an associate economist at Moody's Analytics and a member of the Credit Analytics Group in Westchester, Pennsylvania. Derek works on building stress testing models of consumer loan performance for a number of consulting projects. He has a bachelor's degree in economics from the University of Wisconsin-Whitewater. Chris Derides is a senior director at Moody's Analytics, where he manages a team of economists focused on consumer credit modeling and analytics for banks, investors, fintechs, and other financial institutions. He provides regular commentary to clients and the media on the state of consumer credit markets and small businesses. He received a PhD and Masters in Economics from Johns Hopkins University for his work on income inequality and technological change. Currently, Chris is developing methods for incorporating economic forecasts into loss allowance estimates in order to comply with the new accounting rule, CECL. And now I'd like to introduce Chris Derides from Moody's Analytics to kick off today's program. I'll pass the presenter mode to you, Chris.
Wonderful. Well, thank you very much, Gary, and welcome everyone to our quarterly Outlook session here to discuss some of the key trends that we're seeing in small business specifically. I'm going to kick us off with an overview of some of the key economic trends, things that are driving our outlook and our forecast that do have an influence on small business. I will keep my comments brief up front here, and I look forward to a lot of your questions throughout the session here today. So I'm really going to focus on some of the highlights in the U.S. economy today. I will also identify perhaps some of the blind spots that are affecting the banking industry, things that we want to watch out for, some of the key risks to think about as we go into 2019. So as we look at the economy today, despite a lot of market turmoil and a lot of noise, let's say, from the media in terms of tariffs and Brexit and all sorts of issues going on in the world at large, the U.S. economy, when we look at the economic indicators, does continue to perform quite well. Growth remains quite strong, above potential or above some of our trends throughout much of the recovery period here, so that's certainly a positive. We're growing at about a 3% year-over-year rate still. Employment remains strong. We have job growth that I'll talk about in a moment, and we have wages also supporting consumers, creating some consumer confidence and supporting some consumer spending as well. So all those factors are positives. A lot of the positives are still being supported or motivated by the fiscal stimulus that we put into the economy earlier this year, right, through the tax cuts that went into effect, lowering corporate income taxes as well as taxes on individual households as well, and some of the deficit-financed spending that Congress authorized earlier in the year as well. A lot of that spending was for defense contracts, which typically do take some time to make their way into the economy. So only now are we really starting to feel the effects of those spending, that increased spending, and that's something that, by all measures, should continue to propel the economy forward, at least over the next 2-3 quarters. If we can make it another 8 months from here, the economy will have reached a milestone. It will have become this will become the longest expansion in U.S. history at 10 years and 1 month. Right, so again, all of the indications are that at this point that there is still enough momentum in the economy that we should easily hit that particular milestone. Now, that said, there are a number of risks to the economy and things that we should bear in mind. They may not hit us over this 8-month period, but there are certainly things we want to think about as we think about the next 12 or 24 months. On the one hand, the positive effects of growth can have some negative consequences in the form of shortages, right? And already we do hear reports of certain industries, certain companies having a problem finding qualified workers or workers with the right skills in order to continue growing or expanding their businesses. We do note housing shortages, particularly affordable housing shortages in many markets. And again, that could restrict some of the potential for economies to grow or for businesses to expand if say, workers cannot find housing in the areas that those businesses are located. Beyond that, we can think of risks to the outlook that are perhaps a little bit more tangible in terms of tariffs or the prospect of increasing tariffs. We can think about rising interest rates and the influence that that would have on slowing some economic growth and the specter for some increased inflation. Right now, those are really the 3 main risks that we at Moody's Analytics are focused on, say, over the next 12 to 24 months. We can think about other potential risks, right? So some limitations on policy. If we do get into trouble, how is the Fed going to respond? The federal deficit, right? Do we have the room to do some additional stimulus spending? Maybe not. So we could think about some of the consequences of some of those broader issues around inequality or lack of infrastructure spending and what that means for our long-term potential growth. But in the near term, again, over the next 12, 24 months, these are issues that are unlikely to push us into recession, although they make it more difficult for us to get out of recession if we do fall down or if the economy does slow. But before we get into some of the risks, let me just say a word about some of the strengths, and in particular, the most important strength when it comes to consumers and small businesses has to be the strength of the job market, right? Most of our economy is based on consumer spending, so if the job market is strong, then consumers are going to be more willing and able to spend, and that's going to really propel our growth. And here we do have some very positive signals, right? The unemployment rate is at or near a 50-year low at 3.7%. We do continue to add jobs to the economy. November was a little bit light in terms of job growth, or lighter than expectations in terms of job growth. We added 155,000 jobs to U.S. payrolls. Although that is a little lighter than expected, it's still enough to offset all of the jobs that we need to keep up with population growth, and then some. So we are able to continue to pull people back into the labor market who may be sitting on the sidelines. So there is some certainly concern about the labor market, and maybe we are reaching the end of the cycle here, but for the time being, it does look as though we have still quite a bit of growth potential in the jobs market. And one indication of that is if you look at the demand side of the labor market, what we can see is that U.S. businesses are still reporting a record 7 million job openings. So we have more job openings at the moment than we actually have unemployed individuals, and that again is a very positive sign for consumers in terms of their confidence in the labor market or their ability to get a job if they should become unemployed, if they get laid off for whatever reason. So still there is a lot of impetus or a lot of momentum when it comes to the labor market going forward. The quit rate is also quite high in the U.S. job market. That is also a positive sign. If people are quitting their jobs, they're often moving to better positions for better pay or better benefits, or a better match for their skills and interests. And that should help propel the economy forward through greater productivity, right? People are taking jobs that are a better match for their skills. That should lead to some productivity growth going forward. So the job market gives us some very positive signs, again, at least in the very short term. Let's talk about the next 12 months here. Where we see some risks are on the tariff side or the trade side of things. And it's not so much that the direct impact of tariffs would be large. After all, the U.S. is not all that dependent on foreign trade, or certainly less dependent on imports and exports than other countries around the globe, such as countries in Europe like Germany, or certainly China, highly dependent on its export industry. So the fact that we have imposed tariffs has certainly been felt around the country, but for the U.S. economy overall, it hasn't been a catastrophic type of event. This is something that the U.S. economy can stomach given the current strength in other parts of the economy. At least that's been the case until now. The real risk that we see on the horizon here is that we have some escalation in the trade wars or the trade situation with China, right? So if we do take tariffs up to, say, a 25% tariff on all Chinese goods, that is certainly going to be felt by U.S. businesses and small businesses in particular. We do import about 50% of the imports that we receive from China are actually in capital goods and intermediate goods. So these are goods that U.S. businesses use to create or manufacture final products or deliver final services. So as those tariffs rise, that's effectively a tax on businesses that so far they've been able to manage given strength in the dollar and some other offsetting effects like lower taxes. But at some point, we would imagine that there is a tipping point in terms of tariffs rising so high that businesses do have to pass along more and more of the costs of those tariffs to consumers, and that would certainly crimp demand. So as we think about the regional impacts that tariffs could have, you can see that we identify the Midwest as being particularly vulnerable, along with the South and Northwest parts of the countries, and that's really a reflection of agricultural commodities that are exported out of the Midwest, chemicals and petroleum that is exported out of the South, and aircraft manufacturing and semiconductor manufacturing that we have predominantly in the Northwest. Right, so there will be regional impacts. So if you are a lender with certain concentrations, you certainly would want to be aware of what those concentrations look like in the event that the tariff war does escalate to the next level. Beyond that, we identify interest rates as a major risk to the economy as well. We are in a rising rate environment here, or at least we have been. We do expect the Federal Reserve will raise rates once again later this month out of some concern of rising inflation or some potential overheating when it comes to the labor market, some rising in wages that might lead to pricing pressures going forward. After that, though, we do believe that the Fed is going to pause. It is going to be data-driven. And so next year is certainly in a wait-and-see mode in terms of how many interest rate hikes, if any, the Fed engages in. The real risk to those increases in interest rates are, one, it's an increased cost to consumers and small businesses in terms of the loans that they receive. And then there is a potential for the so-called inversion of the yield curve, where the longer-term interest rates, say on the 10-year Treasury, do fall below the short-term interest rates, say on the 2-year Treasury. Anytime we've seen that type of an inversion in the past, a recession has typically followed in the United States, and so that is certainly something to watch. At this point, the curve has not inverted, at least this 10 versus 2-year Treasury rate has not inverted, and therefore it's not a red signal at this point, but it's certainly getting very close to inversion. That's something we definitely want to keep an eye on. Beyond that, as we think about the next recession, and one thing that is certain is that we will have another recession someday, we identify commercial lending as perhaps the area that is at greater risk of either triggering the recession or being particularly vulnerable to the next recession. And this I would identify as a potential blind spot for some banks, although this is an issue that is gaining increasing visibility. So it may not be as blind as perhaps a few quarters ago. The concern here is that business debt, and I'm using non-financial corporate debt as a measure of overall business debt here, has been increasing throughout the cycle. You can see that it's much higher than it was during the previous peak or during the previous expansion. And the debt to GDP ratio for this non-financial corporate debt is also very close to its record highs. What particularly concerns us is the expansion in so-called leveraged lending. So this is lending by banks and other lenders to businesses that are already leveraged, right? So effectively you can think of this as a loan that is made to a business that's already in debt, in the hopes that with this loan, with this additional capital, that business will be able to turn around, create profits that allow them to pay back all of the debt outstanding. What we can see in the chart here is that there's been quite a sharp increase in the amount of leveraged lending from about $800 billion in 2012 to around $1.4 trillion as of our last read in 2018. So a sizable increase in the amount of this leveraged lending is out there. And this lending can be quite profitable and quite sustainable when rates are low and the economy is performing. But once rates rise, that could certainly put pressure on business balance sheets. And so we're worried or concerned that these rate hikes and potential overheating of the economy could expose some of the weaknesses that we see in some of these portfolios. Outside of leveraged lending, we also see that in general, lending to businesses has been easing over the last few quarters here. If we look at the net percentage of lenders that are tightening their underwriting standards on C&I loans or small business loans by extension, what you can see here is that we have been in a loosening cycle. Given that the economy overall may be in the late stages of the expansion, this does present some risk of potential losses if and when the economy does start to slow down. So that is our primary concern. Finally, I'll end with an overview of our recession probabilities. We do track a number of economic indicators, and as I mentioned at the very top of the hour here, most of those economic indicators are flashing green. We only have a few signs of real weakness in the economy at this point. However, as we combine those indicators together and create models that project or predict probability of recession, say within a 12-month period, we do see that the probabilities are rising. The probability is still low relative to history, right? So currently we're projecting about a 1 in 4 chance that the economy could be in recession within the next year. That is low from historical standards, but it is up over the last year. So there are certainly some signs of deterioration when it comes to the yield curve, higher interest rates, as well as some potential overheating, some potential signs of inflation as well. So it's not alarmist, it's not a call for a definite recession in 2019, but the conditions are certainly deteriorating today relative to where they were perhaps a year ago. With that, I'm going to stop and turn the floor over to Derek, and certainly look forward to answering some of your questions as we get to the end of the presentation here. Derek?
Yep. All right. Well, thank you, Chris. As I'm sure most of you know, if you've listened before, what I like to start out by doing is talking a little bit about the data set that we have and what makes it unique in the small business credit realm. So the data that we at Moody's get from Experian contains credit data for about 7 million small businesses. This gives us a huge amount of coverage across the country, across regions, industries, so we can really dig down and see what's happening within subsections of the small business credit market. All right, getting to some of the data, it kind of looks like small business delinquencies, or at least improvement in delinquencies, has bottomed out for this cycle. So we're seeing, and we have been seeing for the last year and a half, a lot of movement around the roughly 1.6% rate for 31 to 90 days past due rates on small business credit. And when we look at other buckets outside of this range, we see that there's still improvement in 91 plus day and charge-off categories, but that's still just things that had been delinquent before and moved into default, rolling off of rolling off of books as active accounts. So as those are decreasing, we still see improvement in the overall small business credit market, but the sort of more natural quarter-to-quarter improvements that we had been seeing in these other earlier stage delinquencies aren't happening as much anymore, which is natural for where we are in the cycle, but it does mean, you know, at some point, all expansions come to an end, all periods of good credit will come to an end, and the question is, when will that happen? Well, we're starting to see that conditions may be getting better for, may not be getting better, but may be lending credence to the idea that a turn in the cycle is not too far off. So what you see on the screen now is the Senior Loan Officer Survey, and indicating whether senior loan officers are reporting higher or lower demand for consumer and industrial lending. And sort of going along with the story that I was telling on the last slide, you see there's been a lot of movement around zero, which is no net higher demand for C&I loans. So there's been a lot of movement around zero in the last year and a half, 2 years, where some quarters are very good, others not so much. So overall, we're kind of getting a net washout in what senior loan officers are reporting in terms of demand for new commercial lending. Getting back to the Experian data, we've seen that in 2017 there was a bit of a bump up in utilization rates as within the Experian portfolio there were increases in balances that weren't necessarily matched by increases in available balances. However, that trend has sort of shifted where now we're seeing that the amount of available credit outstanding has increased to bring utilization rates back in line with where they were in 2016 at around 39% of available credit utilized, which does mean that small businesses have a lot of capacity in case they need borrowing, but it does mean also that perhaps they don't have good enough reasons to borrow, to draw on these lines of credit that they have available and expand, which isn't necessarily good in terms of the macroeconomy, but in terms of credit performance, you know, it's not necessarily a bad thing, seeing that there is capacity available. Taking a regional view, you can see that higher in the 61 to 90 days past due bucket, higher year-over-year balances are sort of concentrated in the Southwest and Plains states, whereas in areas such as the Southeast and New England, which historically have had stronger improvement, we aren't seeing as much of an increase in delinquency rates. And I'll get into this more in the subsequent slides, but part of this comes down to the industries that are prevalent in these areas. So in the Southwest, a lot of what we're seeing right now is in the construction industry. And in the Plains and mountain states, a lot of what we're seeing is in the mining industry. And in the history of our data, we have seen that those are two of the more volatile industries. So we would expect, you know, those are going to be the ones driving a lot of the movement, especially early on in a cyclical shift. But what we're seeing, you know, is evidence that that may be what's occurring right now. So in the Southwest, there has historically been a relationship between construction, the construction industry, and housing prices. And as Chris was talking about, one of the risk factors that we're looking at in the economy overall is housing. And given that the Southwest is particularly exposed to housing and house prices as a source of wealth, as a source of equity, it can be a big factor in driving small business delinquencies in that region. So I think this slide actually sums up better the point that I'm making here. So you can see that the blue, purple, and green lines represent 3 of the 4 larger metro areas in the Southwest region, and the brown line represents a 4th, Tulsa. And looking out into 2019, we can see that home prices in Tulsa are forecast to continue increasing at about a 2% rate. But the other metro areas don't necessarily have the same price increases in the Moody's baseline scenario. So we could be seeing, before it happens, that construction is going to take a further hit in 2019 if home prices continue on their projected path, which is for little to no improvement, as those construction firms are perhaps not as able to repay their borrowings as they would be if the homes that they were building and selling were increasing in price. And then looking at the mining industry again, which is more in, it is in the Southwest, but also in those mountain states, we can see when we look at the price of oil lagged 4 quarters that decreases in the price of oil correspond very well with rising delinquencies, which you see in the blue or turquoise line on this chart. And you can see that back in 2016, as delinquencies were rising, that oil prices 4 quarters before that had just taken a plunge. And after having spoken with one of our oil focused economists, we concluded that a roughly 4 to 5 quarter lag would be appropriate in terms of looking for firms to not be able to repay on their borrowings. So this made a lot of sense. And then if you look out into the 2019 period, where oil prices are going to be coming back down to little or no change, and possibly even moving into lower levels than in the year before period, once again, we may encounter the issue where borrowers in the mining space aren't able to repay their borrowings as well as perhaps they thought when they were taking out these loans, extending these lines of credit, which could cause issues for them several quarters down the line. So as we move into the new year, that may be one of the areas to focus on in terms of where are our risk factors. So I'm going to leave you with that, and I will hand the presentation over to Gavin.
Okay, thank you very much, Derek.
Thank you, Derek. Welcome, everybody. Good to be here with you again. So we have looked at the macroeconomic factors. We have looked at some more detail on a regional level, and now what we would like to do is look into the portfolios in a little bit more detail. To do that, we look at a data set that has a lot more granularity and detail than some of the more macro level data. This particular data set is called Small Business Credit Share. So it is entirely small businesses. It consists of tens of millions of individual transactions every month across a range of products, a range of credit facilities, and it provides a lot of detail. So it's a good data set to explore, to try and understand in a little bit more detail what's happening within the portfolios, and perhaps to try and anticipate potential downturns or potential negative trends. So as we take a look at this, we break the data down into regions. See the regions pretty clearly. This matches what Derek just described a couple of moments ago. So we will look first at installment loans. A couple of reasons why we pick installment loans. So the first thing is an installment loan is not something that a small business goes out and gets overnight. Generally, there's a little bit more effort, a little bit more cost. The underwriting standards in general are a little bit more stringent. So it involves more thought, more time on the part of the small business. It is a fixed commitment, fixed payment. So it's a different, it's a kind of a unique and interesting financial mechanism to look at. So when we look at the various regions, we explore three categories. One is variations in average balances and installment loans year over year. Variations in the 91-day delinquency category year over year, and balance charged off. A couple of things to note here. I won't read through each individually, but a couple of things to keep in the back of our minds. The first is, as Derek said, the overall trend for several quarters now, for many quarters, has been very positive. So delinquency levels, loss levels, charge-offs, and so on have been historically low. So that means when we see variations that may look significant in pure delinquency terms. So for instance, if we look in the West, we see that balance charged off has dropped to 1.18%, and that shows up as 69.77% drop. It may seem like a significant drop. In pure dollar terms, it may not be that significant. It could be related to just the timing of the charge-offs. It could be related to, large contributors going through their portfolios and clearing out longer-term delinquencies in the third quarter. So as we look at the trend overall, by each region, it continues to be positive. The balances, there's some variabilities in terms of how they are growing, but not a significant variance. So in summary, the overall picture in terms of installment loans, credit quality, balances, and so forth remains pretty positive. This supports the overall position that Derek outlined a little earlier. As we look at this in more detail, you'll see that the one area in terms of region that there's a little variation on is in the Southwest. I think Derek's comments address that pretty well. The only thing I would add is that if we continue to see the Southwest on this upward trend, when we look at Q1 18, Q2 18, Q3 18, we're seeing a significant difference between the Southwest and all of the other regions. If that continues to grow to that extent, and if we see some other variations on a specific product or delinquency category level, then at that point, we might recommend a little bit of a deeper dive into the portfolios to understand what other lead indicators may be available that could point to perhaps a significant regionalized downturn in credit quality on the small business side. When we look at originations, what I'd like to point out here is when we look at last quarter and the prior quarter, we see a significant difference with this quarter. However, if we stand back and look at the overall trend going back to Q3 of 2016, the current quarter account originations fall broadly in line with the longer-term historical levels. So at 4.31, let's be clear what that is. That means that when we look at the overall population of installment loans, when we look at the overall portfolio, 4.31% of those loans were originated in the last quarter. If we dig in a little bit more detail, we look at regional variations. we can see some significant differences particularly from the northeast to the west. One more thing to note is that we are talking about percentages that may look large when we look at a 12.95% drop, for instance, in the Northeast versus the same quarter in 2017. Percentage terms looks significant. When we actually dig in and look at the overall volumes and we look at the longer-term historical trends, this is not something that is a major cause for concern. If we continue to see those trends over the next several quarters, and we see, for instance, an ongoing drop in, for instance, the installment loan origination rate in the Northeast, and say that combined with a drop in line of credit originations and with increased delinquency, when we start to see those multiple factors compound, then at that point, that might be one of those causes for concern that would trigger perhaps a deeper look into the portfolio. So beyond just the origination level, if we look at the quality of those originations, and we look at those and think about them in terms of a potential predictor of longer-term performance for those specific quarterly originations, this is what we see. Now, let me be very clear on what this is. Let's take the top line as an example, since that is higher than everything else and somewhat remarkable. So this is the medium to high risk category. The risk is defined by the Experian credit score and telescore. So what this says is that 11.3% of installment loans were originated. Let me pause for a second. What it says is when we look at the high risk category on installment loans, when we look at that overall portfolio, 11.36% of those loans were originated in the last quarter. Once again, this might seem remarkable. However, it's important to remember that we are not talking about significant volumes, number one. And number two, regardless of the provider, so whether we're talking about banks or fintechs or credit unions or across the whole range, we are seeing that originations and raw numbers are much, much higher, obviously, in the better quality small businesses, and the sheer number and dollar value of originations in the higher risk categories is lower. One further comment, which I should have probably stated early on, is we're going to look at a lot of slides here. Some of them I'm not going to go into a lot of detail on because we will be distributing the information afterwards. And a lot of it is pretty self-explanatory, and it's useful for you to have available, useful for you to look at in detail, but doesn't require a lot of explanation during the webinar. So as we look at balance risk trends within installment loans, you can see the mix. Essentially, look at these columns as the total installment loan portfolio and the color variations within them as the various risk bands. And once again, you will see that by far the bulk of the portfolio is in the low, medium, and medium risk bands. That is a very positive aspect and feature in terms of withstanding the next downturn, in terms of the projected overall credit portfolio performance and quality. So once again, reinforces the earlier statements about the overall sustainability, the overall strength of the small business credit segment. Compared to two slides, We've got balance by risk trend, accounts by risk trend. So the first is dollar values and balances. The other is the portfolio risk mix by number of accounts. Once again, digging in a little bit more deeply, trying to find any potential causes for concern, any potential lead indicators of a downturn or overall deterioration. What you will see in this is a slight uptick across the various categories in terms of average balances by risk. Comment here is nothing dramatic, nothing to be concerned about, but once again, something that says to us, okay, if we see slight upticks across the board, then we are going to be very interested to see, do those quarterly upticks turn into trends, and are those trends perhaps lead indicators of that downturn or turn in credit quality that we are all trying to predict. Look at the delinquency trends in terms of balances. We see here, if we look from the top to the bottom, okay, we've got 91 days plus balances past due, flat over the last several quarters. We see charge-offs dropped significantly over the last quarter. The one comment on that would be we don't put a lot of store in single quarter drops in charge-offs because there is some significant variability in terms of how banks, finance companies, credit unions, and so on in terms of the timing and scale of charge-offs. So once again, if we see a consistent trend developing, that may help us in terms of understanding that longer-term viability, sustainability, quality of the portfolios. When we look at the 30 and 60-day categories, you're not seeing significant upticks. You're seeing decent stability there, continuity. So that tells us that there are no signs right now at the current and slightly past due end of the portfolios that there is a significant turn imminent. 91-day delinquencies by categories. This, again, just provides a little bit more detail to what Derek reviewed a little earlier. We don't have significant commentary to add on that. So let's look at lines of credit. So we said a little earlier that installment loans require a little bit more thought, a little bit more effort to put in place, fixed repayments and so on. Lines of credit are a little different. Derek talked about utilization a few minutes ago, so utilization relates at least partly to lines of credit. Small businesses look on lines of credit and credit cards as a relatively quick source of short-term financing. The use and performance in these small business lines of credit can be a more leading edge indicator than an installment loan of overall performance. So when we look at that, when we look across the country, we see similar variations, just as we described in installment loan, and I would caution you similarly on the lines of credit that some of the percentage variations are significant. However, when we look at the numbers behind that and just pure numbers, pure scale, the variations may not be as dramatic. 91-day delinquencies, overall the trend is consistent over the last several quarters. Slight upticks in the Midwest and the West. The continuing word of caution is a one quarter uptick does not a trend make. So we would be very interested to see how those states and regions do over the next several quarters. Lines of credit originations, once again, we are talking about the originated lines of credit in the last quarter versus the overall volume of lines of credit, the overall portfolio. The drop last quarter was pretty significant. It brings the origination level down even below the historical low over the last 12 quarters of 4.09. We dug into the data. We didn't see any particular factor or influence. So our position on this would be that we will look at it next quarter. If it comes back up to historical levels, then we would consider it an anomaly. If it doesn't, then we will add additional data and continue to dig until we find out exactly what that cause would be, because at that point, it would be a trend and potential cause for concern if the overall level of originations on line of credit dropped back significantly. Year-over-year originations, variations by region. I will leave that to you to look at it after the webinar. Once again, you will see some significant variation by regions. In general, in the regions, you will see that most of them, the variation year-over-year is not significant. Interesting graph here. So across all the categories and lines of credit, across all the categories, the new accounts originated as a percentage of the overall portfolio dropped. That could be an indicator of, as Eric said a little earlier, small businesses taking a wait-and-see attitude, perhaps being a little conservative in terms of investment. And as he also said, perhaps even not having the need to access the money. So once again, not so much a specific cause for concern, but more of a wait-and-see approach where if we see similar data next quarter, then we will dig into it in a little bit more detail and look at that as potentially a cause for concern or a lead indicator. And then once again, as we look at the balance by risk trend within lines of credit, you are seeing the overall portfolio quality mix across all the quarters, and once again, very heavily weighted in the medium, low, medium category in terms of risk. So good mix on the portfolios. The portfolios are not high risk, so the probability of them performing well is much higher than them underperforming. Once again, we will continue to look at that to try and identify those potential lead indicators, potential triggers, potential signs of trouble over the horizon. We look at risk and balance combined. You can see that the overall trend, the last couple of quarters has been relatively stable. Risk has not dramatically increased in any of the categories in terms of dramatic increases. If we look at the medium-high risk category, slight uptick. So once again, if we see that continue, then potential cause for concern or for some more research and analysis. But for now, we continue to see a solid underlying growth, solid sustainability, project good performance for the portfolios. The signs at a very granular portfolio level are that the small business segment continues to be strong and on a good footing. Utilization rates, pretty much as Derek described, stable, potentially flat in some of the categories, but definitely not a massive increase in spending or indications of very high levels of investment. So potentially, once again, a small business sector standing back, looking at what's happening and being cautious in terms of their decisions on investing. Delinquency trends, flat or low, once again reinforcing that underlying message. Derek addressed some of the detail in this earlier in terms of variations across the different categories. My message would be no significant dramatic increases in delinquency in general across the various industry categories. Our overall picture is very positive, as Chris and Derek explored a little bit earlier. The underlying portfolios, as we dig into their performance on a very detailed level, the portfolios are strong. The indicators are all positive. We see some minor changes, minor upticks that are not so much a cause for concern in themselves, but if we see them continue over multiple quarters, then we would most likely change our story and recommend a little bit more research and diving into the portfolios. Risks, as Chris outlined earlier, shortages, tariffs. So lots of factors and influences to be aware of. But once again, the fundamentals remain very strong. Thank you for your time. Let me pass the microphone back to Gary. And Gary, we may have some questions.
Yeah, thanks very much, Gavin. Excellent points there. We did have a question that came in regarding GDP, and that was posed to us by Nate Kelly. Delighted to get a question from Nate. Nate, as some of you may know, used to work with Moody's and used to co-present this very webinar. And he asks, are there any hypotheses as to what has fueled the structural increase in the non-financial debt to GDP ratio over the years? And Chris, I believe you were going to address that.
Yeah, absolutely. So great question. Hi, Nate. Always good to hear from you. In terms of the motivating factor or the causal factor for some of that increase in business lending that I identified, I would point squarely to the low rate environment, right? That low interest rate environment makes it attractive, certainly for borrowers to seek credit, and perhaps more importantly, you had investors seeking higher yields than what they could get from more riskless type of assets. Business performance or performance on business loans has been very strong, was very strong, so it makes sense that investors would be entering that market, providing more credit to that market, so consequently the rise in volume. So I don't dispute that, or I don't argue with that type of logic to seek out some yield in that market. The other thing to note is that business loans don't carry all the restrictions that consumer loans have in terms of consumer protections. So if we think about fintechs and some of the newer lenders coming into the industry, it also makes sense for them to perhaps target small business and business lending in particular as a first step or first foray into the credit markets as well. They just don't have as many restrictions or compliance issues when it comes to lending to those markets versus, say, consumers. So again, I think there was a host of issues that motivated some of the increase in supply of credit that led to supported some of the increase in demand as well. So as I mentioned during my remarks, it's something to watch. All right, we're not at sky-high levels or absurdly high levels in terms of the amount of business debt that's out there, but certainly it has risen, and particularly that leveraged lending market is one to keep an eye on.
Okay, thank you. There was one question, I believe Derek may be taking this one, about explaining what the main factors drove the Southwest's high delinquency.
Yeah, yeah, Gary, I can take that one. So I touched on in the presentation the housing and construction industries in the Southwest being one of the areas that we're definitely looking at in terms of what's driving the increasing delinquencies in the Southwest. But the other industry that's also increasing in terms of delinquencies there is services. So
I'm afraid I don't have data to back this up, but my hypothesis would be that in the last quarter, some of the market volatility that we've had would have affected wealth effect spending in that region.
Mm-hmm.
We would have seen a pullback in terms of not only kinds of houses people are buying there, or whether they're buying houses there at the moment, but also what they're willing to spend on services in the area. And just because I have the numbers at the top of my head, construction really is the driving force there. Delinquencies in the severe 61 to 90 days past due bucket were up from 1% to 1.2% of outstanding balances, and that came on the back of new home sales declining almost 7.5% from September into October, and new home sales being down almost 10 or 11% year over year. So we are seeing a lot of risk stemming from the housing market at the moment for small business credit, and that isn't solely confined to the Southwest, but the Southwest does have a large housing effect. So we are seeing a bit of an outsized impact there, or maybe just a first impact in that region.
Okay, excellent. Well, we're going to have to leave it there, folks. There are a few other questions, but we will get to them next time. We'll try and reply privately to those. I would like to thank everyone for attending today's session. Thanks also to Derek and Chris from Moody's Analytics, and to Gavin from Experian for sharing your insights with us. When you close the webinar, we would ask that if you could just take a moment to answer a few brief questions. It really helps us improve these webinars for you and be responsive to the topics that you want us to cover. Also look for a follow-up email from us with information about the event, including links to the recording and the presentation slides. And for more information on Moody's Analytics, go to moodysanalytics.com. And of course, the Main Street Report, you should all be aware of that, but you can download that from bit.ly/Q318MSR. And for more information on Experian's business information services and products, please go to experian.com/B2B. We will see you next quarter for the next quarterly business credit review. Thank you, everybody, and have a good day.